What is the value strategy and how does it work? Hello and welcome to today's video. The value strategy is an investment strategy where investors try to find stocks of companies that are trading below their fundamental value, e.g., book value, cash flow. They believe that these stocks will generate a higher return in the future when the market recognizes their true value. The value strategy was developed by Benjamin Graham, 1894 to 1976, and David Dodd, 1895 to 1988, both professors at Columbia Business School in the 1920s. They published the book Security Analysis in 1934, in which they established the basic principles of value investing. Benjamin Graham is considered the father of value investing and has inspired many well-known investors, including Warren Buffett, himself a successful value investor. Graham's approach was to buy shares in companies trading below their fundamental value, in the expectation that the market will recognize their true value in the future and share prices will rise. Such companies can be identified by good assets, stable earnings, and an overall high market position in the industry. The stock price, on the other hand, should be low, so you can forecast high rising profits based on the data about a company. In the value strategy, the focus is not on short-term profit increase, but the long-term profit increase of such companies is particularly exciting and lucrative. In order to execute a value strategy, financial analysis tools are primarily required to study and evaluate the fundamentals of companies. Some of the most important tools that can be used include: 1. Financial reports. Investors should thoroughly review a company's most recent annual and quarterly reports to gain an understanding of its financials, results of operations, and growth potential. 2. Financial ratios. Investors should use key ratios such as price to earnings, P/E, price to book, P/B, and cash flow per share to determine if a company is undervalued. The price to earnings, P/E, ratio is a financial ratio used to determine whether a stock is undervalued or overvalued. It is calculated by dividing a stock's current price by its earnings per share. Earnings per share, or EPS, is a company's after-tax profit divided by the number of shares outstanding. A low PE ratio indicates that the stock may be undervalued, while a high PE ratio may indicate overvaluation. A small calculation example: you get the price-earnings ratio by dividing the price of a share by the earnings of a share. For example, if the stock price is $100 and the expected earnings are $8 per share, the PE is 12.5. The value of 12.5 tells you that it will take about 12.5 years for the company to earn the earnings of the individual stock. The lower the PE, the more favorable the share is valued. The price-to-book ratio, PB ratio, is a financial ratio used to determine whether a share is undervalued or overvalued. It is calculated by dividing the current price of a share by the book value per share. Book value per share is the total value of a company's assets minus its liabilities, divided by the number of shares outstanding. A low PB ratio indicates that the stock may be undervalued, while a high PB ratio may indicate overvaluation. With both ratios, there are that a low PB or PE ratio does not always mean that a stock is a good buy. It may also indicate that the company is in trouble or has a poor outlook. It should always be considered in conjunction with other financial ratios and factors. 3. Stock prices. Investors should track a stock's current market price and historical prices to see if a stock is trading below its long-term average price. 4. News and analyst opinions. Investors should also read news about the company and analyst opinions about its future prospects to get a better understanding of the company and decide if it is a good choice for a value investment. 5. Financial and stock analysis software. There are also many financial and stock analysis software that investors can use to collect, analyze, and visualize financial data to study company fundamentals faster and more efficiently. If you like this video, we appreciate a thumbs up and you subscribing to our channel. However, what sounds simple in theory is quite complex in practice. Therefore, below are the advantages and disadvantages of the value strategy for an individual investor. The value strategy has several advantages over other investment strategies, including potentially higher returns. By buying stocks of companies that are trading below their fundamental value, value investors believe that these stocks will generate higher returns in the future when the market recognizes their true value. Risk mitigation. Since value investors try to find stocks of companies that are undervalued, they usually have some assurance that they will not invest in stocks of companies that are overvalued and therefore have higher risk. Fundamental analysis. Value investing closely examines fundamental data, such as financial analysis and company data, which helps to gain a better understanding of the company and its future prospects. Long-term perspective. Value investing requires patience and a long-term perspective, as it involves tracking down undervaluations that are often only identified in the future. Diversification. By investing in a variety of companies and industries, you can minimize risk and increase the chance of higher returns. Like any investment strategy, the value strategy has some drawbacks, including long holding periods. Value investing requires patience and a long-term perspective, as it involves seeking out undervaluations that are often only identified in the future. This can mean investors have to wait a long time before they see a return on their investments. No guarantee of higher returns. Although value investors believe they are buying stocks of companies that are trading below their fundamental value, there is no guarantee that these stocks will generate higher returns in the future. Risk of mispricing. Because value investors try to find stocks of companies that are undervalued, there is always a risk that they will err and invest in stocks of companies that are actually overvalued. It is possible that other strategies will underperform. In certain market periods, the value strategy may underperform other strategies, such as growth strategies that focus on companies with strong growth potential. Time-consuming. Conducting thorough financial analysis and identifying undervaluations can be time-consuming and requires a certain level of expertise and knowledge of financial ratios and company data. In practice, it is not easy to find an undervalued stock, especially in the beginning. You will spend a lot of time analyzing the financial data, and at the same time, you will study a lot of companies that are not undervalued in the stock market. Therefore, it will take you a long time to find an undervalued stock. In addition, you need a lot of knowledge and experience, which you can only acquire over a long period of time. Nevertheless, you deal with the financial ratios at a low level and protect yourself from investing in overvalued stocks, which may make a price correction shortly after your purchase, and you recover your invested money only after decades, if at all. Be sure to note, however, that a cheaply valued company on the stock market may also represent high corporate debt future high expenses, or profit declines. It is important to emphasize that value investing does not guarantee higher returns, and like any investment strategy, carries risks. It's important to do thorough research and understand financial ratios and company fundamentals before investing in a stock. If you are not willing to put your time and effort into researching value stocks, then you can also invest in stock funds or ETFs with a value strategy. However, in this case, we advise you to do your own financial analysis of at least some companies beforehand. Warren Buffett's portfolio is also always worth a look. Berkshire Hathaway is a company run by Warren Buffett, a successful value investor who has achieved impressive performance for decades. Therefore, it is understandable that many investors would want to look to Berkshire Hathaway to profit from Warren Buffett's success. However, it's not just you doing this, but thousands of others as well. So there are a few things you should keep in mind. Berkshire is highly diversified as a company and invested in many different companies and industries. You should check if it fits your investment strategy and risk profile. The very large company is better able to absorb risk and setbacks than small companies or individual investors. Even Buffett has made expensive mistakes and invested wrongly. Therefore, do not blindly follow his opinions and decisions, but also do your own research. That was today's video about the value strategy. Do you run the strategy for your stock portfolio? Thanks for watching.